Hello and welcome everybody to the weekly market forecast for Wednesday, July 5th. A lot of exciting topics to cover today, so let's jump right into the presentation. First of all, a couple of quick disclaimers. First of all, a risk disclaimer. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. Secondly, a hypothetical trading disclaimer. The information in this webinar is provided as general market commentary and does not constitute investment advice. In other words, we're giving educational material in this webinar. It doesn't constitute specific trade recommendations and so forth. It's a technical presentation today, but even in the context of technical analysis, you do want to be aware of what's going on in the fundamental picture. Especially big news releases. So let's take a look at what's going on the calendar today. Later on today, we got factory orders in the States, IBD tip economic optimism. Both of these fairly light economic figures. But later on in the day at 7 p.m. GMT, we've got the FOMC meeting minutes from the June 13th and 14th meeting, which is a very important figure. Could move many of the currencies, especially the US dollar. And you may recall that in the June meeting, the Fed lifted rates and signaled one more rate hike for 2017. Let's talk about what we're going to cover in today's presentation. We're going to look, as usual, at key support and resistance levels, recent and emerging chart patterns. We're going to cover technical indicators, and we're going to cover trading strategies. Let's take a look at the tools we're going to use and key takeaways from today's presentation. What I hope things that I hope you'll learn from today's presentation. We're going to look at trend lines and patterns using trend lines, so flags, pennants, triangles, that kind of thing. We're going to look at multiple time frame analysis in our trading strategies. We're going to look at moving averages and touch on the most important moving averages, and also look at moving average crossovers. We're going to look at momentum oscillators. My preferred oscillators to look at are stochastics, RSI, and MACD. And we'll also look at Fibonacci briefly. And our trading strategy today, as was the case last week, it's another breakout strategy. So we'll get to that in just a second. So now let's jump in and take a look at the strategy of the day, which is a very simple kind of set and forget strategy. It's the daily high-low breakout strategy. Let's take a look. So this strategy is based on the concept that if price breaks out, it breaks through yesterday's higher low, there's a higher chance, a higher probability that it's going to continue, the trend will continue in the direction of the breakout. It's a very simple system, and you can increase your odds of getting successful trades or successful signals by being aware of the market context, and we're going to get into that a little bit now. So for example, a breakout in the direction of the trend across multiple time frames will provide a stronger signal typically, and you can use other factors also, like momentum oscillators, that can help you gauge the strength of the signal. Let's get into the rules of this daily high-low breakout strategy now. Good currency pairs to look for this trading strategy to begin with would be the euro against the dollar, the pound against the dollar, and the dollar yen. Good time frame to look at would be the daily or 4 hour. This is what kind of enables it to be a set and forget strategy. You can kind of put your orders in, put your profit target and your stop loss in, and kind of walk away. Which is good in a way because it can prevent you from over trading, which is a problem for a lot of rookie traders. So the rules are place a buy stop above yesterday's high, the candle of the prior day, and a sell stop below yesterday's low. As soon as one of the orders is filled, cancel the other order. So you don't want to get filled on both of these, you just want to enter with one order. And so next up, where should you put your stop loss and profit target? Set your stop loss at the mid-range of yesterday's candle. So the prior candle, look for the the center point and put your stop loss there, whether you're long, whether you got in the market long or short. As far as your profit target, set your profit target at twice the amount of your stop loss. So if you got a 20 pip stop loss, you'd be looking for a 40 pip profit target. One final thing relating to the rules of this strategy are don't trade it around the release of major economic news, because that will typically shake up the picture and invalidate the technical picture on the charts. Certainly in the shorter term time frames. Sometimes even around major news you'll find that technical levels on longer time frames like the monthly chart is still valid, but this is not a strategy that you're going to be trading on the monthly chart probably, so try not to trade it around major releases. Okay, next up guys, let's jump over to the charts and we're going to look at these examples on the charts. Okay, so let's take a look at our daily high-low breakout strategy. We're looking at dollar yen here and we're on the daily chart. So with this strategy we wanted to look at the prior day. So here's our prior day, here's the high and the low, and so what you would have done to get set up with this strategy would be to put a buy stop above the market here and a sell stop below the market here to get started with. And as we can see, prices moved higher, so you would have got filled on your buy stop order. So what you'd want to do after that is cancel your sell stop order and then put in your stop loss and your profit target orders. So your stop loss, as we said, was at the midpoint of the prior day's candle, so your stop loss would be here and your profit target would be twice that. So your profit target would be like around up here somewhere. The other factors that we mentioned in using this strategy is you want to be aware of the what kind of trend you're in across multiple time frames. And so looking at the trend that we're in right now, we can tell that we're in a modestly upward sloping trend here, looking at the 200 period simple moving average. So what did that tell us? That told us that perhaps we would want to favor a breakout to the upside. So I mean, there's a lot of different ways that you could use that. Perhaps you want to put use a larger size order or so, but it's something to be aware of, is to be aware of the trend not only on the daily chart but across multiple time frames. You could look at the shorter term time frames as well as the longer term time frames, and if it's an uptrend across all of them, that's all the better, and you're probably going to want to favor a breakout to the upside. Again, looking at momentum oscillators can be helpful. Here we can see stochastics, they're in overbought territory, but that wouldn't actually dissuade me from getting into this trade because the slope is still nicely sloping upwards. If it was coming down and crossing below the 80, that might make me more reticent to get into that trade. So there's the daily high-low breakout strategy. If you have any questions about it, feel free to send me an email at webinar@OctaFX, and this webinar is recorded so you can always refer to it on YouTube also. Next up, let's look at some of the exciting chart patterns that we have on the daily charts. There's an interesting one here in one of the currency crosses. Currency cross is a pair that does not contain the US dollar. So here we have the Canadian dollar against the Japanese yen, and we have a classic chart pattern here, an inverse head and shoulders. So here we have one shoulder here, here's the head, here's the second shoulder. And the way you typically trade a head and shoulders or an inverse head and shoulders is you trade a breakout of the neckline. So a head and shoulders is a bearish reversal pattern, and then the inverse of a head and shoulders is a bullish reversal pattern. So this is a bullish reversal pattern, and we can see we got a really nice neckline here, which is a nice horizontal resistance level just in its own right. It's been tested here, 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 so that's a really nice level. So what we could expect if price it manages to break through this neckline here, I might expect to see some nice follow through, a nice fluid move to the upside. Next up, let's look at the pound against the yen, the GEPI, one of the most volatile pairs out there, and an interesting one to follow and trade as long as you're careful. Here in this currency pair we have an ascending triangle pattern forming. We've got a nice upward sloping trend line to the downside here. It's been tested several times, and the nice horizontal resistance to the upside here. Pulled up the 200 period simple moving average, and we can see that this is really come into play. Look at how many times the 200 period simple moving average has been tested here, multiple times. You could almost develop a trading strategy just off of this, trading a bounce off the 200 period simple moving average. What else does it tell us, this 200 period simple moving average? It tells us, since price is above it, that we're in an uptrend, and it's the bulls are more in charge here. So in terms of a breakout in this ascending triangle pattern, we might be favoring a breakout to the upside here above this horizontal trend line. Moving on, wanted to go back to this silver chart. Silver is a market that's been trending very nicely on the daily time frame, and what I had done previously is put up the 5 and 10 period exponential moving averages on the chart, because the crossovers of these two shorter term exponential moving averages can create some great buy and sell entries to kind of hop on the change in the trend. So here we saw a really nice instance of that. The moving average is crossing over in a almost stair step down move off of that. I also like to look at the momentum oscillator in conjunction with this, and we could see it right about the time that the crossover took place. Stochastics was moving from roughly above 80 to below, which is another bearish signal, giving confluence to that trade signal. Again, exponential moving averages, don't be freaked out by the technical sounding language. It's just a moving average that puts more weight on the more recent periods as opposed to a simple moving average. So again, silver, great trending market on the daily chart, and 5 and 10 period EMAs, good ones to experiment with in nicely trending markets if you want to catch a reversal in the trend. Now we're moving on. We're looking at the silver daily chart, and we can see that there was a nice channel here, and when we pull up these trend lines and triangles and channels and this kind of thing, what we're looking for is these breakouts. And this chart's kind of interesting because you can see how the breakout came into play here. Price broke down through here, and look where it retraced back to in both instances here, right back up to this lower channel line. So what a trader might have done in this situation would be to be aware that once this line's been violated, it was support. Prior support can become resistance. So the support level was violated, price traded lower, came back up, and that prior support level became resistance on two instances here. So that's something to be aware of. When you have a good trend line and it's broken, it's violated, it can change from support to resistance and vice versa. Let's take a look at gold. We also had a nice break through this upward sloping trend line here, and a nice follow through, a nice long body candle here off of that breakout. I've got the 50 and the 200 period moving averages here, and we can see that we're more in bear territory here since we're below this that key support level, and we're also below the 200 and below the 50 period moving averages. Another breakout occurred on this nice formation in dollar CAD, and this happened just in this case just the way you might have hoped. A really long bodied red candlestick off it, almost a Maribozu, and not much in the way of support to the downside, but I did pull up the 200, which I would expect may provide support as price begins to get down there. Australian dollar against the US dollar. I like to pull this one up to emphasize the importance of the longer term time frames. Really nice resistance to the upside here, kind of a wedge pattern forming on the monthly chart. And keep in mind, guys, that when you're looking at the different time frames, the signals on the longer term time frames have more predictive value. So if you're looking at something on a 5-minute chart, it doesn't carry the weight of something that's on a 4-hour chart or a daily chart. And then when you go even further out, look at weekly and monthly chart, the technical indicators from these charts are even more powerful. So it's really interesting to pull up the monthly, and if you can find something interesting on it, like this upper part of the wedge formation here, you might expect to see really nice follow through over a long time frame if price can break through here, and similarly to the downside. Pull up the British pound quickly. This is a good chance to pull up the Fibonacci levels. We had a nice swing to low here, and prices retraced back up to the 38% level, almost to the 50% level, and it's been hovering around the 38% level. We can see at least here that the 38% level has come into play. In my experience, the 50% level is the most powerful, even though it's not actually a Fibonacci level. Many technical analysts have picked up on this, WD Gann being one of them. So do watch out for the 50% level here, and it looks like the 38 is going to continue to come into play a little bit here in the British pound. Finally, let's move over and look at the euro against the dollar. We can see that price has retraced to this important horizontal level here, which was a prior level of resistance and is now likely to come into play as a level of support. Up above this prior high here, back from February, provides a level of resistance to the upside. If price is able to break below here, we have a trend line down here which may provide support, and again the 200 period simple moving average as a level of support also, and also telling us that we're more in bullish territory since price is trading above the 200 period simple moving average. So with that, I would like to conclude the presentation for today. I want to thank you all very much for joining me, and hope to see you at the next event. Good trading in the markets. Bye for now.